Stop thinking all AI stocks move the same, because right now, one company at $2.81 is building AI-powered robotics, while another at $4.65 is controlling smart security systems. Now this is where it gets interesting. Same AI wave, completely different outcomes. So which one actually moves first? AI isn't slowing down. It's accelerating into real-world systems, robotics, automation, security, infrastructure. But while billions flow into the biggest names, there's a growing disconnect underneath the surface. Because right now, there are companies sitting at just $2.81 and $4.65 per share, already positioned inside this shift. Now, this is where it gets interesting. One is tied to AI-driven robotics and autonomous operations. The other is embedded in smart security and identity systems. So the question is, why are both still priced like early-stage plays? And more importantly, which one actually benefits faster as AI expands? But here's the catch. Not every low-price stock is an opportunity. AI is no longer just software, it's becoming infrastructure, from automation systems to defense applications to real-world deployment layers. And as this expansion grows, something predictable happens in markets. Capital flows first into the obvious leaders, but the deeper layers, they often lag behind. This is where pricing inefficiencies usually exist. This is the type of layer institutions quietly watch, long before broader attention shows up. Now, this doesn't guarantee anything, but it explains why this area matters. Because if AI continues moving into physical systems and security frameworks, the supporting layers become critical. And this is exactly where smaller cap opportunities tend to form. Think about one of the hardest environments for AI to operate in. Not data centers, not controlled labs, but unpredictable, real-world physical environments where conditions change constantly, where human access is limited, and where automation becomes not just useful, but necessary. But here's the catch. Most AI companies don't operate here because it's complex, expensive, and technically difficult. Now this is where things get interesting. Some companies are building AI systems designed specifically for these environments, blending robotics, autonomy, and real-time decision-making. And the second stock we'll cover? It operates in a completely different layer, which makes this comparison even more important. This fits directly into the AI plus robotics plus automation layer, and that matters more than it seems. Because if automation expands into industries like offshore operations, defense, and infrastructure, then autonomous systems become essential. If this layer expands, companies like this don't just participate, they become critical. And this is the part most people miss. This is exactly where institutions start tracking early signals. Looking at the stock, it traded at significantly higher levels during earlier market cycles, then pulled back as sentiment shifted across small-cap tech. Now it's stabilized around $2.81. So the question becomes, is this just a struggling small cap, or a company waiting for the right automation wave? The company focuses on autonomous robotic systems, particularly in challenging environments like offshore and industrial operations. This includes AI-driven vehicles, remote systems, and automation platforms. Not hype-driven, but real-world deployment-focused. And this is where things shift. Because when you actually look at the company behind this, you're looking at Nauticus Robotics Inc., ticker KIT, trading around $2.81 per share. So why is it still this cheap? Because adoption takes time. These systems don't scale overnight, and the market often waits for proof before pricing it in. This doesn't mean it moves tomorrow. There are risks here. Execution, contracts, and demand cycles all matter. Timing is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI is expanding rapidly into physical systems, some of these companies are seeing delayed market reactions, meaning the technology moves first, the stock price follows later, and that gap is where opportunities sometimes exist. But unlike the first company, which operates in physical robotics and automation, this one sits inside digital security and identity systems, where the focus isn't movement, it's control, access, and verification. And this is where it gets interesting. Because as AI scales, security becomes just as important as capability. This company focuses on AI-driven identity, authentication, and IoT security systems. Think access control, smart devices, and secure environments. As more systems become connected, security layers become critical, not optional. If AI adoption continues across enterprises and smart infrastructure, then companies managing identity and security naturally become more relevant. Because without secure systems, AI deployment becomes limited. Looking at the stock, it previously traded at higher levels during stronger market periods, then saw a correction, and now sits around 465 per share. So again, the setup becomes familiar. Past strength, pullback, stabilization. Now the question becomes, this is where it gets interesting. Because the company behind this model is Identiv Inc., ticker INV, trading near $4.65 per share. So why hasn't it moved? Because growth depends on adoption speed and execution. Enterprise deals, scaling, and demand all take time. This doesn't guarantee anything, and there are real risks here, but the positioning is what makes it worth watching. Now here's where it gets interesting. You're looking at two completely different AI plays. One is robotics and physical automation. The other is digital security and identity infrastructure. So the real question becomes, which one moves first? If AI expands deeper into industrial and offshore automation, then robotics could accelerate faster. But if AI adoption grows through enterprise systems and smart infrastructure, then security layers may see faster demand. Then there's risk. Robotics depends on deployment scale. Security depends on adoption and integration. And price-wise, both are still in low-cap territory, but their paths are very different. Zooming out. Both of these companies sit in parts of the AI ecosystem that aren't fully priced in, not because they don't matter, but because they're not obvious. And this is the layer that tends to move later, but often more aggressively. This is where institutions look for inefficiencies. This is where market gaps exist. And this is where positioning matters more than hype. If you're following where AI is actually expanding, not just where attention is, these are the types of setups worth keeping on your radar.